SPY is down 8% from its all-time high. The VIX just hit 30. The CNN Fear and Greed Index is sitting at 15, extreme fear. And right on cue, every influencer on the internet is posting, market is down, here's what I'm doing. Most of them are either panic selling or telling you to buy the dip with zero framework behind it. So here's exactly what I am personally doing with my own positions right now. 2 specific strategies, both backed by data. Scroll through any finance feed right now, and you'll see the same content recycled. The market is crashing. Get out now. Buy the dip. None of them show you actual positions. None of them give you the math. They're reacting to price, not analyzing structure. The S&P 500 hit its all-time high closing price of $6,978 on January 27th. Since then, we've had 5 consecutive weekly losses, the longest losing streak since 2022. That's real. But reacting emotionally to a losing streak is how you turn a temporary drawdown into a permanent loss. Let me show you the numbers. SPY is trading at $634.09, roughly 8% below the January all-time high. The VIX is at 30.10. CNN's Fear and Greed Index reads 15, extreme fear. 5 straight weeks of losses. $1 trillion has left U.S. equity markets. Those are facts. But facts without context are just fuel for panic. Here's where it gets interesting. I'm not panicking because I have a plan, and the plan was built before the correction happened. That's the entire point. You don't design your strategy during a drawdown. You design it in advance and then execute it when the drawdown arrives. I have 2 active strategies right now, and neither one involves sitting on the sidelines watching my screens or panic selling into weakness. Strategy 1, the wheel. On my high conviction stocks, I'm continuing to sell options and collect premiums, the exact same way I was doing it before the correction. I haven't changed my delta settings. I haven't widened my strikes out of fear. The delta was set for a mathematical reason, and market noise doesn't change that math. Most people miss this. The moment you let emotion override your delta selection is the moment you break your own edge. Here's the calculation. In normal market conditions, a disciplined will strategy generates 1 to 2% monthly premium on your positions. That's 12 to 24% annualized income from premiums alone, before any stock appreciation. The key is keeping your delta consistent. Your delta was chosen based on your probability of assignment, your premium target, and your conviction level. Changing it because the market dropped 8% is not risk management. It's emotional trading disguised as caution. Here's what most will traders don't calculate during corrections. The VIX long-term average sits around 19. Right now it's at 30. That means implied volatility is roughly 58% above its historical average. In practical terms, the premiums I'm collecting right now are 50 to 70% higher than what I'd collect in a calm market. The correction isn't hurting my wheel strategy. It's making it significantly more profitable. Higher fear equals higher premiums. The math rewards you for staying disciplined when others won't. Strategy 2. Swing trades on SPY and the major indices. And my rule here is simple, don't get washed out. Most of the dramatic price action you're seeing right now isn't retail traders panicking. It's algorithms. The biggest algo systems are programmed to fire at critical index levels, and when they trigger, they amplify moves far beyond what fundamentals justify. During this correction, Algo trading amplified a 6% single-day drop when SPY hit key support levels on the S&P 500. That wasn't organic selling. That was programmatic execution cascading through the order book. If you're setting swing trade entries based on gut feel during these moves, you're not trading the market. You're trading against machines designed to exploit exactly that behavior. I refuse to enter that game without a confirmed signal. Here's my personal indicator for swing trade reentry. VIX recovery. Specifically, I'm waiting for the VIX to pull back into the 15 to 20 range before I set up any new index swing positions. Why that zone? An iPresage study covering 7 years of data found that bullish plays initiated when VIX sits between 15 and 20 had a 68.3% win rate. That's not a guess. That's a statistically validated reentry window. And here's the data that keeps me patient. After the August 2024 VIX spike, a comparable fear event, the S&P 500 returned positive 6% over 1 month, positive 11% over 3 months, and positive 18% over 6 months. Broader analysis from TastyLive covering multiple VIX spikes shows a 65% chance the market is higher 1 month after a spike like this one, with an average gain of 9.2%. Extend the horizon to 3 and 6 months, and the conviction only builds. The longer you hold after a VIX spike entry, the stronger the historical evidence gets. I'm not trying to catch the exact bottom. I'm waiting for a measurable, repeatable signal. VIX recovery into the 15 to 20 zone. That tells me the selling pressure has been absorbed. No signal, no trade. Discipline over prediction. So that's exactly what I'm doing right now. I'm running my wheel strategy at the same delta settings I always use, collecting premiums that are 50 to 70% higher than normal because of elevated volatility. And I'm waiting for VIX to recover into the 15 to 20 zone before re-entering any SPY swing trades. This is my personal strategy. All traders have their own approach. Do your own research. This is not financial advice. If this kind of data-driven framework helps replace guessing with calculation for you, subscribe and follow my live trades on Tiger Brokers. The link is in the description. Stop guessing. Start calculating.